What if the biggest question on Wall Street isn't how much money companies are making today, but how much they're spending to control tomorrow? Hundreds of billions of dollars are pouring into artificial intelligence infrastructure, semiconductors, servers, data centers, power systems, cooling equipment, networking, and real estate. Amazon expects approximately $200 billion in capital expenditures during 2026. Alphabet projects between 175 billion and 185 billion. Meta expects between 130 billion and 145 billion. Microsoft reported $41 billion of capital expenditures in its latest quarter alone. But here is the $1 trillion question. Are these companies building the infrastructure for the next industrial revolution, or are they building too much too quickly at prices that may never produce the expected return? Because spending money is easy. Turning concrete, chips, and electricity into profitable growth is the hard part. Today, we're following the money behind the greatest corporate capital spending cycle of the modern era. This is Wall Street Wednesday. This is the Great CAPEX Bet. Spend today, profit tomorrow, or build too much. Good morning, ladies and gentlemen. Welcome to the Unbearably Bullish Podcast, the official podcast of the Bull You Can't Bear. I am your host, Donald Johns, where we focus on strong markets, stronger mindset, and unlimited opportunity. So let's get into it. First, what exactly is CAPEX? CAPEX stands for capital expenditures, money a company spends to acquire, construct, or improve assets expected to benefit the business beyond the current year. That could include a manufacturing plant, a warehouse, an aircraft, a power generation facility, a fiber optic network, a data center, servers, processors, and networking equipment. If operating expenses keep today's businesses running, capital expenditures attempt to build tomorrow's business. Think of it this way. Operating expenses buy the ingredients for tonight's dinner. Capital expenditures build the restaurant. CAPEX usually doesn't hit the income statement as one immediate expense. The asset is placed on the balance sheet and generally expensed over its estimated useful life through depreciation. That accounting distinction matters. A company may spend billions in cash today, while the related expense reaches reported earnings over several years. That means earnings can appear resilient even as free cash flow comes under pressure. The cash has already left the building. The accounting expense is simply arriving more slowly. The current spending race is being driven primarily by one belief: AI demand will require an entirely new layer of global infrastructure. Training and operating sophisticated AI models requires enormous computing capacity. That capacity requires advanced chips, servers, networking, storage, cooling, land, and dependable electricity. This is no longer simply a software story. It is an industrial build-out. Amazon reported $96.3 billion in cash capital expenditures during the first 6 months of 2026. The company has said that most of its technology infrastructure investment supports AWS growth. Alphabet spent $44.9 billion in the second quarter, with most of that directed toward AI technical infrastructure. Approximately 60% went towards servers, while roughly 40% supported data centers and networking equipment. Meta spent more than $31 billion during its second quarter and now expects full year 2026 capital expenditures of approximately $130 billion to $145 billion. Microsoft reported $41 billion in quarterly capital expenditures, with roughly 2/3 going toward shorter-lived assets, primarily CPUs and GPUs. That last point deserves attention. A data center building may produce value for many years, a cutting edge processor may become economically outdated much faster. Not every dollar of CapEx carries the same lifespan, risk, or potential return. Here is where Wall Street gets conflicted. Investors want companies to capture the AI opportunity, but they also want disciplined spending, strong margins, and growing free cash flow. Wall Street says, build the future. Then quarterly report arrives, free cash flow declines, depreciation rises, and Wall Street asks, why are you spending so much? That tension is at the center of the CapEx debate. Alphabet generated negative free cash flow of $5.9 billion in its second quarter, largely because of capital investment. At the same time, Google Cloud's backlog reportedly reached $514 billion, providing evidence that substantial customer demand exists. Microsoft says customer demand continues to exceed available supply, while its AI business surpassed $37 billion annual revenue run rate during fiscal 2026 third quarter. NVIDIA's first quarter fiscal 2027 data center revenue reached $75.2 billion, up 92% from the prior year, showing that infrastructure providers are already capturing extraordinary demand. The bull case has evidence, but evidence of demand does not eliminate execution risk. The question isn't simply whether AI grows. The question is whether future revenue and cash flow justify the amount, timing, and price of today's investment. We have seen this movie before. Railroads transformed commerce, but excessive construction also produced bankruptcies and consolidation. The telecommunications boom built fiber networks that became essential to the digital economy, but many investors lost money when capacity arrived ahead of demand. Energy infrastructure powered industrial growth, but poorly timed projects sometimes produced debt, write-downs, and stranded assets. The early internet created enormous long-term value, but not every company financing the revolution survived long enough to collect the returns. That is the paradox of transformative infrastructure. The technology can change the world while some of the companies funding it still destroy shareholder capital. Being correct about the future is not enough. You must also be correct about price, timing, financing, utilization, and competitive advantage. A revolutionary industry can still contain terrible investments. Let's do the bull versus bear. The bull enters the boardroom and says, demand is real. Capacity is constrained. AI adoption is accelerating across businesses, governments, and consumers. Companies that fail to invest now may surrender their competitive position. The bull sees data centers as the factories of the digital economy. It sees computing power as productive capacity. It sees today's spending creating tomorrow's recurring cloud revenue, subscriptions, advertising improvements, enterprise contracts, and operating efficiencies. The bull's argument is simple. If this technology becomes as foundational as electricity or the internet, underbuilding may be more dangerous than overbuilding. Then the bear walks in carrying the invoice. The bear says, slow down. Demand forecasts can be wrong. Chips depreciate quickly. Power availability is limited. Construction costs are rising. Customers may develop cheaper models, use less compute, or negotiate lower prices. The bear worries about falling utilization rates, margin pressure, high depreciation, technology excess capacity, debt and lease obligations, revenue arriving later than expected. The bear also asks an uncomfortable question. What happens if every major technology company builds for the same future at the same time? The answer could be an extraordinary new economy or an extraordinary amount of duplicate capacity. The bull focuses on what could be gained. The bear focuses on what must be earned. A disciplined investor listens to both. So, how can investors evaluate the great CAPEX bet? Use the CAPEX scorecard. Number one, revenue growth. Is the new capacity producing additional revenue, or is spending rising much faster than sales? Number two, free cash flow. Capital investment can temporarily pressure free cash flow, but investors should look for a credible path toward recovery and expansion. Number three, return on invested capital. Is management generating returns above the company's cost of capital? Growth without an adequate return can destroy value. Number four, utilization. A fully contracted data center is very different from an expensive facility waiting for customers. Capacity only becomes productive when somebody pays to use it. Number five, depreciation. As infrastructure enters service, depreciation increases. That can pressure reported margins even after the construction spending is complete. Number six, financing. Is the company funding expansion with operating cash flow, debt, finance leases, outside partners, or some combination? The source of the money affects both risk and flexibility. Number seven, backlog and customer commitments. Signed contracts and credible demand signals are more valuable than projections. And number eight, management discipline. Does leadership adjust spending when conditions change, or defend every project simply because construction has already started? That is the trap of sunk cost thinking. A dollar already spent does not automatically justify the next dollar. The opportunity extends beyond the largest technology companies. Every major infrastructure cycle creates suppliers. Follow the money into semiconductors and advanced packaging, networking equipment, power generation and transmission, cooling and thermal management, data center construction, electrical components, fiber optic connectivity, cloud software and cybersecurity, real estate and infrastructure financing. But remember, being connected to a popular theme does not guarantee profitability. Some suppliers may possess pricing power and durable competitive advantages. Others may face competition, customer concentration, or falling margins. Don't stop at the headline. Trace the economics through the entire capital stack. Who provides the financing? Who builds the facility? Who supplies the equipment? Who purchases the capacity? Who carries the risk if demand disappoints? And most importantly, who ultimately earns the return? Here is this week's Wall Street Wednesday challenge. Choose one company participating in the AI infrastructure build-out. Then answer 5 questions. 1. How much is the company spending? 2. What assets is it buying or building? 3. How is the investment being financed? 4. What measurable demand supports the decision? 5. What evidence would prove the investment is or is not working? Don't begin with the stock price. Begin with the cash flow statement, then examine revenue growth, depreciation, backlog, utilization, and return on invested capital. Your objective is not to predict one quarter. Your objective is to understand the economic engine being constructed. Here's the bull's bottom line. CAPEX is where corporate ambition becomes financial commitment. Press releases describe the opportunity. Capital expenditures reveal what management is actually willing to bet. The Great CAPEX Bet may produce the infrastructure behind the next generation of economic growth. It may also create periods of excess capacity, margin pressure, and painful write-downs. Both outcomes can exist inside the same revolution. So don't only ask, how much are they spending? Ask, what return must this investment generate? How quickly can the asset become productive? How long will the technology remain competitive? And who carries the risk if the forecast is wrong? Because spending today does not guarantee profits tomorrow. Execution, utilization, and return on capital determine whether CAPEX becomes an asset or an anchor. This is the bull you can't bear. This is the Unbearably Bullish podcast. Follow the money, measure the return, think like an investor, not like the crowd. Strong markets, stronger mindset, unlimited opportunity. Follow the herd and always stay unbearably bullish. I'm Donald Johns, and I will see you the next time. We love and appreciate all of you. Have a great day.